I want you to think about what a few years of disciplined ownership can do. Most people look at a stock and ask a very short-term question. Where is it going next week? Where is it going next month? Is the next $10 higher or lower? That is not how I think. I try to look at the system underneath the price. What kind of business is this? How fast is it growing? How durable is the customer relationship? How large can the market become? What are the risks that can kill the thesis? What is the valuation relative to the possible future? And most importantly, what does the next 5 to 10 years look like if the company keeps executing? That is the right time frame for growth investing. Not 5 minutes, not 5 days, not 5 weeks. 5 to 10 years, a lot can change in that amount of time. A portfolio can change, a net worth can change, a life can change, but it does not change because someone gets excited for 1 month and then quits. It changes because a person keeps making decisions with structure. Work hard, work smart, save, invest. Evaluate businesses. Do not overpay blindly. Do not panic when the market goes through difficult phases. And do not forget that the stock market is not only a collection of prices, it is a collection of businesses. That is where the opportunity is. In this moment, there are 4 growth stocks that I think deserve serious attention. Each one is different. One is trying to become a new kind of bank. One is a software platform that may be misunderstood because of AI fear. One is a beauty company with a powerful brand model and a new acquisition that could accelerate growth. One is a beverage company that still looks early in a category where some of the greatest long-term consumer stocks in history were built. All 4 are growth stocks. All 4 have risk. None of them are guaranteed, and no one should ever confuse enthusiasm with certainty. But when I compare their current valuations with the possible earnings power several years out, I see attractive asymmetry. That word matters. Asymmetry means the possible upside appears much larger than the downside under reasonable assumptions. It does not mean the downside does not exist. It means the odds and payoff structure deserve attention. The first business is SoFi Technologies. SoFi is not just another fintech application that is too narrow. The better way to think about SoFi is as a modern financial operating system for a younger customer base. Banking, credit cards, investing loans, personal loans, crypto access, financial products inside one platform. That is the direction. The old banking model was built around branches, physical infrastructure, tellers, local offices, ATMs, legacy systems, and heavy overhead. That model worked for a long time. It still works for some of the biggest banks in the world. But younger generations do not necessarily want their financial life to begin in a branch. Millennials, Gen Z, eventually Gen Alpha, they are much more comfortable treating financial services as a digital platform. That is where SoFi's opportunity sits. If a person's first serious bank relationship is not JP Morgan, Wells Fargo, Bank of America, or another legacy institution, then SoFi has a chance to capture that relationship early, and a banking relationship can become very valuable over time. A young customer may start with a small balance, then income grows, the person invests more. The person borrows, the person opens credit cards, the person refinances loans, the person starts a business. The person's financial life becomes larger. If the institution keeps the customer, the lifetime value can grow dramatically. That is the core logic of banking. Attract customers. Keep customers. Do not blow up in a recession. Those 3 principles matter more than most people realize. Banking can look complicated because the statements are filled with categories, loans, interest, income, charge-offs, capital rules, funding costs, securitization, and regulatory details. But at the highest level, the machine is simple. Bring in customers. Offer financial products, earn spreads and fees, control risk, survive downturns, keep compounding customer value over time. SoFi is trying to run that machine with a much lighter structure than the traditional banks. No massive branch network, no legacy physical footprint in the same way. A more technology-based platform that can create a different margin structure if execution is strong. Now, the recent numbers matter. SoFi's earnings came out recently in the source document, and the income statement was strong. Total interest income rose 31%. Total interest expense rose only 16%. That means net interest income grew 39% year over year. For a banking-related business, that is a very important metric. Loan origination, sales, securitizations, and servicing were up 169%. Loan platform fees were up 44%. Another category was up around 86 to 87%. Total non-interest income rose 49%. Total net revenue rose 43%. Sales and marketing was up 41%, but that was still lower than revenue growth, which matters. Income tax expense rose heavily, up 279% year over year. Even with that headwind, Net income grew 135% year over year. Diluted EPS doubled. That is not a weak business. That is not a company standing still. That is a growth engine beginning to show real profitability. I would describe that as high-quality execution, but execution must continue. That is the key. SoFi cannot simply have one good quarter and call the job finished. Financial institutions are tested over cycles. The real test is not only growth in good conditions, the real test is whether the company can keep attracting members, retain those members, avoid reckless risk, and survive the next major recession. Every bank eventually faces a cycle where credit quality gets tested. Loans go bad, consumers weaken, funding costs change, capital markets tighten, risk models are challenged. If SoFi wants to become a banking giant, it must survive that kind of period. That is one of the main risks. Anthony Noto has done a strong job running the company, but he must keep doing a strong job. In banking, one bad risk culture can destroy years of growth. The trick is to grow aggressively without taking foolish credit risk. That is not easy. Now, look at the member growth. At one point in 2022, SoFi had about 5.2 million members. By the end of last year, it had 13.6 million. Now it is around 14.7 million in the first quarter. The member count keeps rising. That is the sign of a platform gaining scale, and scale matters in financial services. The large U.S. financial institutions often have tens of millions of customers. Some have 50 million, some have much more. If SoFi can move from 14.7 million toward 30 million, 50 million, or 70 million over the next 5 to 10 years, the business changes dramatically. That is the big thesis. Not that SoFi is already JP Morgan. It is not. JP Morgan has a market cap around $824 billion in the source narrative. Bank of America is around $372 billion. HSBC is around $339 billion. Morgan Stanley is around $298 billion. SoFi is around $20 billion. That difference is the opportunity. If SoFi becomes a major financial institution over the next decade, a $20 billion market cap may look very small in hindsight. A company like this could potentially become a $100 billion business. Maybe several hundred billion if execution is excellent and the banking model scales in a more asset-light way than traditional players. But that is the upside case. It is not guaranteed. The business must keep compounding members. It must control credit risk. It must keep product quality high. It must keep brand awareness rising. It must avoid the mistake that kills financial companies, which is lending too aggressively because growth feels exciting. The market will reward growth, but regulators and credit cycles punish arrogance. So I see SoFi as a powerful long-term growth stock with a clear risk. The upside comes from becoming a modern banking giant. The risk comes from banking itself, credit recession, risk management, funding execution. At the current price around $16 in the source, the valuation still looks attractive relative to the long-term possibility. Under $15 is an especially attractive buy zone in the Source S framework. Under $10 would be a steal, though one should not expect that price to return. $15 to $20 is still a very good zone. $20 to $25 remains a good buy zone. $25 to $30 becomes more of a maybe zone, where the risk-reward becomes less attractive. Above $30, it becomes more of a hold. That is a disciplined way to think. Not every price is the same. A great business can be a bad buy if the price is wrong. A risky business can be a good buy if the price discounts too much fear. SoFi at $16 is still in an area where the long-term opportunity appears attractive. The second business is ServiceNow. ServiceNow is a different kind of opportunity. The stock has been hit hard in the source document. It is down 52% over the past year and trades around $91. That kind of decline forces a question: is the market seeing a permanent impairment, or is the market overreacting to a transitional phase? That is the key. ServiceNow is a software business serving large companies. It makes tools that help workers handle tasks, fix problems, automate workflows, track requests, and organize work inside one platform. Large companies often operate with many messy systems. ServiceNow helps simplify and coordinate that work. Once the software is installed and integrated into daily operations, it can become difficult to replace. That creates stickiness. This is one of the holy grail characteristics of enterprise software: recurring subscription revenue, deep customer integration, high switching costs, important workflow role, strong cash flow potential, long customer relationships. A business like this can be very valuable if it keeps growing. The problem right now is that ServiceNow is in an awkward phase. There is fear around AI. Investors are asking whether AI will disrupt software companies like ServiceNow, Salesforce, and other subscription platforms. Will customers need fewer seats? Will AI replace some functions? Will pricing models shift from seat-based to consumption-based? Based, will new AI-native companies attack incumbents? These are reasonable questions. The market hates uncertainty when investors cannot understand terminal earnings valuations compress. That is part of what is happening, but AI can also be an opportunity. ServiceNow already hosts and organizes important enterprise workflows and data. If AI becomes more embedded in enterprise operations, platforms that sit in the middle of those workflows may become more valuable, not less. The risk is real. The opportunity is also real. That is why this is not a simple story. In addition, ServiceNow has completed a number of acquisitions. Acquisitions can add strategic capability, but they also complicate the cost structure. Integration costs rise, expenses rise. AI integration also adds costs. So right now, revenue growth looks strong, but earnings growth looks muted. Revenue is up around 22%, while diluted EPS is up only 2%. The market sees that gap and worries. It says, why is revenue growing so much faster than profit? Is the business deteriorating, or is this a temporary investment phase? That is the central judgment. I believe it is likely a transitional phase. The business remains strong. Customers remain loyal. The revenue base is recurring. Cash flow is strong. The product is deeply embedded in big companies. The CEO, Bill McDermott, is a serious operator. The company has a powerful position. So when the stock gets punished as if the business model is permanently impaired, I pay attention. Now, look at the long-term financial path. The source document base case expects revenue growth around 17% on average through 2030. That is slower than the 22% the company is doing now. So the base case already assumes deceleration. Net income growth is expected around 22% on average from 2027 through 2030. For a software company with recurring revenue, strong customer retention, and a platform role inside large enterprises, a 30 to 35 price to earnings multiple could be fair under those assumptions. That would imply a stock price around $237 to $277 over the next 4 or 5 years. From $91, that creates an expected compound annual growth rate around 30% in the base case. That is attractive. The bull case is stronger if revenue grows around 20% and net income grows around 25%. On average, a 40 to 60 PE could be justified for a business with this quality and growth profile. That could put the stock somewhere from the mid 300s to the low 500s over time. That would be very strong upside. The bear case is important because it shows the margin of safety. If revenue growth falls to 12% and net income growth also averages only 12%. A 25 to 30 PE may still be fair. Even in that lower growth case, the source projection suggests the stock can still produce a double-digit compound annual return and potentially outperform the S&P 500. That is why the stock becomes interesting. A good investment is not only one with a beautiful upside case. A good investment often has a reasonable bear case that still does not destroy you. In the source ES view, the only way ServiceNow fails to make money over the coming years is if the low probability scenario plays out where the business model is completely disrupted. That risk exists. It should not be ignored. AI can change software models. Competition is real. Enterprise software budgets can weaken in a recession. Acquisitions can disappoint. Costs can remain elevated longer than expected. But if the core platform remains valuable, the stock looks too cheap. This is the type of opportunity that appears when the market becomes afraid of a big technological change and temporarily discounts a strong business, as if it is obsolete. Sometimes the market is right, sometimes it is not. The investor's job is to judge whether the fear is proportional. In ServiceNow's case, the fear may be overdone. The third business is E.L.F. Beauty. This is a very different type of growth story. It is not banking, it is not software, it is consumer beauty, but the structure is powerful. E.L.F. is known for affordable cosmetics and high-quality products. Many products are under $10, most are under $20. That matters in beauty. Price and quality can be a devastating combination. A brand that feels modern, performs well, markets well, and stays affordable can take share for a long time. E.L.F. has done that. The core brand is still the big engine. It has strong distribution. It is visible in major retailers such as Walmart and Target. It has a strong value proposition. It understands younger consumers. It knows how to market. It has built a brand that people actually return to. That repeat purchase dynamic is important. Beauty is not a one-time purchase category. People run out of products they buy again: concealer, lip gloss, skin products, makeup, body wash, lotions. If the brand earns trust, the customer repeats. That makes the business more recurring than people might think. It is not software, but it has a repeat consumption rhythm. That is why the source compares it to a SaaS-like business model in spirit. Not because it sells subscriptions in the same way, but because the consumption cycle repeats. If someone loves the product, they come back. Now, E.L.F. also owns Naturium. That brand is growing in skincare, body wash, body lotions, and related categories. It gives the company another growth lane, but the most exciting near-term catalyst in the source document is Rhode. Rhode is Hailey Bieber's company. The brand has become extremely hot in beauty. It is one of the most exciting brands in the space. E.L.F. acquired it, and the short-term opportunity may be significant over the next 1 to 2 years. More retailers, more distribution points, more product categories, more inventory production, more sell-through. A brand that is already supply constrained can grow quickly if distribution and production expand. That is why Rhode matters. The company can use its infrastructure and retail relationships to scale a hot brand faster. Now, the stock trades around $61 in the source document. The forward PE is around 18. For a company with double-digit revenue growth potential for years and strong double-digit EPS growth potential, that is not expensive. It may be too cheap. This is one of the most attractive risk-reward setups in the source analysis. The bull case is dramatic revenue growth of 25% in 2027, then 20% after that, net income growth around 30% annually from 2027 through 2030. If a company has 20% top line growth and 30% bottom line growth in a repeat purchase beauty model, a 35 to 40 PE can be justified. Under that bull case, the stock could move into the $330 to $380 range by 2030. That would be a huge return from $61. But the source assigns that bull case only around a 10% probability. That is important. A bull case should not be treated as the base case. The base case is more grounded, revenue growth around 23% in 2027, then 15% thereafter, net income growth around 20% annually. A 30 to 35 P would be fair for that kind of business. That could put the stock around $206 to $241 by 2030. That implies a 35 to 40% compound annual growth rate. That is extremely attractive if the assumptions are even close. The bear case is also strong revenue growth of 18% in 2027, then only 9% thereafter. Net income growth of only 9%, that would be disappointing for E.L.F. And yet, with a 23 to 28 P, the stock still could produce around 15 to 21% compound annual returns in the Source S model. That is why the setup looks special. When the bear case still offers strong potential returns, the stock deserves attention. Now, what are the risks? Consumer brands can be fickle, beauty trends change. A hot brand can cool. Rhode may not scale as expected. Retail execution can disappoint, margins can face pressure. Competition is fierce. Marketing must keep working. Influencer-driven brands can be powerful but also vulnerable if culture moves on. Valuation can compress. Supply chain issues can appear. A recession can affect discretionary spending, though. Beauty often has resilience because many products are low-ticket items. So there is risk, but the risk-reward at $61 appears attractive because the market may not be fully pricing the growth runway. The Source US conclusion is very clear. Anything under $100 is a strong buy zone in that framework. The fourth business is Celsius Holdings. Celsius owns the Celsius energy drink brand. It also owns Alani, and it recently acquired Rockstar from Pepsi. It also has a major distribution relationship with Pepsi. This is a beverage platform story. The best beverage companies can become extraordinary long-term investments. Coca-Cola, Pepsi, Monster. These companies built immense wealth for long-term shareholders because beverages have powerful business characteristics: repeat consumption, brand loyalty, distribution, leverage, high gross margins, global expansion, shelf space, habit. The product is consumed and repurchased. That is a very powerful pattern. Monster is a particularly useful comparison. Investors who bought Monster very early and held for a long time made extraordinary returns. The reason is that energy drinks became a massive category, and Monster scaled through distribution and brand strength. Celsius is earlier in its journey. The market cap in the Source is about $8.62 billion. That is still small compared with mature beverage giants. Monster is around $73 billion. Coca-Cola and Pepsi are far larger. Celsius is not guaranteed to become a giant, but it has the kind of category and distribution opportunity that can create huge returns if execution continues. The United States business is already much more distributed than before, but there is still room for growth. Celsius and Alani are visible in many stores, but sell-through, shelf space, product expansion, and brand penetration can still improve. The biggest 10-year opportunity may be international. International revenue is still a small percentage of the company's total. That is where the long runway sits. A brand can grow in the United States and then multiply through global distribution if the product fits consumer behavior. Pepsi's involvement matters because distribution is everything in beverages. You can have a great drink, but if you cannot get it into stores, gyms, gas stations, convenience stores, grocery chains, and international channels, the opportunity is limited. A distribution partner can accelerate that. That is what Pepsi did with Celsius. And now Celsius has acquired Rockstar from Pepsi. That gives the company a broader energy drink platform. Celsius, Alani, Rockstar, different brands, different customer segments, different distribution possibilities. This is no longer just one product story. It is becoming a beverage platform. Now, the source notes that Wall Street is becoming more constructive. JP Morgan maintained an overweight rating and adjusted its price target to $67. Stifel, or another firm in the source context, cut its price target to $60. Even after reductions, those targets imply a very large upside from the low 30s stock price described in the source. The short-term opportunity may be a move toward $50 to $70 over the next 12 months, but the bigger opportunity is not the next 12 months. It is the next 10 years. That is the correct frame. Now look at the projections. The bull case for Celsius assumes revenue around $6.8 billion by 2030 and net income around $1 billion. That is not described as crazy in the source. Revenue growth around 15% and bottom line growth around 25% could justify a 35 to 40 PE. That gives a projected compound annual return around 43 to 48%. That is very strong. The base case assumes revenue around $5.9 billion by 2030 and net income around $743 million. Revenue growth around 10% and net income growth around 15%, with a consumption-based model and recurring beverage demand. A 28 to 33 PE may be fair. That implies a 25 to 30% compound annual return. Again, attractive. The bear case assumes revenue around $5.1 billion by 2030 and net income around $516 million, only 5% revenue growth and 5% net income growth per year. That would be a disappointing outcome relative to the opportunity. Even then, with a 20 to 25 PE, the source model suggests a 5 to 11% compound annual return, not spectacular, but still potentially positive. That is a useful bear case. Now, the key opportunity in Celsius is operating leverage. Gross margins can improve, net margins can expand. Revenue growth can continue through distribution, brand expansion, Alani, Rockstar, and international markets. If the company gets the scale economics right, free cash flow can accelerate. This is the type of consumer growth business that can surprise people because the earnings power appears later. At first, the market sees revenue growth and volatility. Later, if scale works, margins can expand and earnings compound. That is the opportunity, but risks are real. Beverage categories are competitive, consumer taste can change, distribution relationships can shift. Pepsi's role is a strength but also creates dependence. Integration of Rockstar and Alani must be managed well. International expansion is difficult. Margins can be affected by input costs, marketing, promotions, and channel mix. A stock like this can be volatile. Again, this is not a guarantee. It is an opportunity with risk. Now, the common thread across these four companies is growth at attractive valuation. SoFi is growing members and revenue while moving toward modern banking scale. ServiceNow is a strong recurring software platform being discounted because of AI fear and temporary profit pressure. E.L.F is a beauty compounder with affordable products, repeat consumption, and a major road growth catalyst. Celsius is an energy drink platform with domestic expansion, Pepsi distribution, Alani, Rockstar, and international runway. Each one has a different business model that matters. You are not buying four versions of the same company. One is fintech and banking, one is enterprise software, one is beauty and cosmetics, one is beverages. That creates some diversification of business type. But they share one thing: they are growth stocks. Growth stocks can be volatile. When interest rates rise, growth valuations can compress. When earnings disappoint, the stocks can fall hard. When the market becomes risk-off, growth stocks can sell off together even if the companies are different. So do not think owning four growth stocks means owning a defensive portfolio. It does not. This is a growth basket. It must be sized accordingly. Now, I want to emphasize something the source document said indirectly through the opening. Do not only imagine the next $10 in a stock, imagine the next 5 to 10 years of your own life. If you continue working hard and investing intelligently, your portfolio can become much larger than you think. But that does not happen by chasing every story. It happens by selecting businesses with strong long-term drivers, buying them at sensible prices, and holding through volatility if the thesis remains intact. At the same time, you must be honest when the thesis breaks. That is the hard part. Growth investing is not blind loyalty, it is conditional ownership. You own the business as long as the long-term thesis remains strong and the valuation remains reasonable relative to the future. If SoFi starts taking reckless credit risk, the thesis changes. If ServiceNow is actually structurally disrupted by AI, the thesis changes. If E.L.F loses brand heat and Rhode disappoints, the thesis changes. If Celsius fails internationally or Pepsi distribution does not translate into profitable growth, the thesis changes. You must know what would make you wrong. That is what separates investing from storytelling. Every stock has a story. The investor must know what facts confirm the story and what facts break it. Now let us compare these opportunities through the lens of business quality. SoFi has platform growth and financial services scale potential. Its advantage is digital distribution, young customer acquisition, expanding products, and asset-light banking potential. Its risk is credit cycles. ServiceNow has enterprise stickiness, recurring revenue, high switching costs, and deep integration inside companies. Its risk is AI disruption, competition, and near-term margin pressure. E.L.F has brand strength, affordability, repeat purchase behavior, and multiple growth brands. Its risk is fashion, competition, and execution around acquisitions. Celsius has beverage category strength, repeat consumption, distribution leverage, and international expansion. Its risk is category competition, margin execution, and brand durability. The best portfolio thinking asks how these risks interact. If the economy weakens, SoFi credit risk may rise. ServiceNow enterprise software budgets may slow, though retention may help. E.L.F may remain relatively resilient because products are affordable, but discretionary beauty can still be hit. Celsius may continue selling beverages, but growth expectations can be reset. In a recession, all four could fall. That is why valuation and position sizing matter. Now, let us think about valuation. A stock price alone means nothing. A $16 stock is not cheaper than a $91 stock simply because the number is lower. You must compare market cap, revenue, earnings, margins, growth, and future cash flow. SoFi at $20 billion market cap is being valued relative to its potential to become a major financial platform. ServiceNow at a depressed price is being valued relative to recurring software earnings several years out. E.L.F at a forward PE around 18 is being valued like a much slower business than the source believes it will become. Celsius under $10 billion market cap is being valued relative to the possibility of becoming a much larger beverage platform. The question is not whether these stocks are cheap compared with cash. The question is whether they are cheap compared with the business they may become. That is growth investing. But growth investing requires a margin of safety because the future is uncertain. If you buy growth at any price, you can still lose money even if the company grows. If you buy growth when the market is too pessimistic, you can make extraordinary returns. That is the opportunity here. Now, let us walk deeper into SoFi because it may be the most misunderstood by traditional investors. Many people see fintech and assume hype. That is understandable because many fintech companies disappointed investors. But SoFi is not simply a payment app or a speculative software story. It has a banking charter. It earns net interest income, it originates loans, it sells and securitizes loans, it collects platform fees, it offers investing and financial products. It has a member base that continues compounding. The company is becoming more like a financial supermarket. The key is whether it can cross from challenger brand to mainstream financial institution. If it does, the current size may be very small. But with banking, growth without discipline is dangerous. The source correctly emphasizes that the CEO must not let the company go under in a future recession. That is the real test. In banking, the best companies are not the ones that grow fastest during good times. They are the ones that grow profitably, keep customers, and survive when credit deteriorates. If SoFi proves that, the valuation can re-rate. Now, ServiceNow requires patience through awkward numbers. Investors dislike a company with 22% revenue growth and only 2% EPS growth. That gap raises suspicion. But if the costs are temporary due to acquisitions, AI integration, and platform expansion, the future earnings power may be much larger than current earnings suggest. This is where long-term investors can benefit from the market's short-term discomfort. The market often punishes transition periods. If the transition leads to stronger strategic positioning, the stock can recover sharply. If the transition hides structural decline, the stock can remain cheap for a reason. So the investor must track customer retention, remaining performance obligations, subscription growth, margin recovery, AI monetization, and management execution. If those indicators remain strong, the stock may be a bargain. Now, E.L.F is about brand and velocity. A low-priced beauty product with strong marketing can grow quickly because consumers can try it without a large financial commitment. That is powerful. A customer does not need to take a big risk to buy a $10 product. If the product works, repeat purchase begins. If social media amplifies the brand, distribution expands. If retailers see strong sell-through, shelf space improves. This creates a flywheel: better products, more attention, more distribution, more sales, more brand awareness, more repeat customers. Rhode could add a second flywheel. The danger is that beauty brands can peak. A hot brand can become less hot. Celebrity connection can help, but it can also create risk. The acquisition must be integrated without damaging the authenticity that made the brand attractive. If E.L.F scales Rhode intelligently, the growth opportunity is huge. If it over-commercializes or loses brand heat, the opportunity narrows. That is what to watch. Now, Celsius is about distribution and category expansion. Energy drinks are habit products. If a person drinks Celsius every day or several times a week, that is recurring demand. Alani has its own consumer base. Rockstar adds another brand. Pepsi distribution can put products in places where independent brands struggle to reach. This is the beverage formula: brand plus distribution plus repeat consumption. If that formula works internationally, the runway can be enormous, but beverage markets are brutal. Shelf space is contested. Monster, Red Bull, private label, Coca-Cola, Pepsi, and many others fight for attention. Marketing matters, flavor innovation matters, margins matter, execution matters. A great category does not guarantee a great stock. The company must keep winning in the aisle. Now, one important principle across all four stocks is that the source is focused on long-term returns, not the next small price move. That is correct. Nobody knows whether the next $10 in ServiceNow is down or up. Nobody knows whether E.L.F goes to 51 or 71 first. Nobody knows whether Celsius reaches 50 before pulling back. Nobody knows whether SoFi tests lower levels before moving higher. Short-term movement is noisy. The long-term question is whether the business value compounds. If you believe the business can be worth much more in 5 years, and the current price gives you a strong expected return, then short-term noise becomes less important, but it does not become irrelevant. If valuation becomes extreme, risk rises. If the thesis breaks, you must react. If the position size becomes too large, trim risk. Long-term thinking does not mean ignoring risk. It means knowing which risks matter. Now, let us discuss the public account context from the source. The portfolio has moved from $3.3 million to $3.85 million in about a month. That is a very strong run. It is exciting. But a serious investor must not let recent success create overconfidence. A portfolio that rises quickly can fall quickly. Success can create the illusion that every decision is correct. That is dangerous. The correct lesson is not to become euphoric. The correct lesson is to ask what process produced the gains and whether that process is repeatable. Was it luck? Was it good stock selection? Was it favorable market conditions? Was it disciplined allocation? Was it concentration? Was it risk-taking that happened to work? Understanding that matters. If the process is sound, continue it. If the gain came from excessive risk, reduce fragility. The goal is not to win 1 month. It is to compound over years. Now, if someone is thinking about buying these 4 stocks, the first question should be personal suitability. Are you a growth investor? Can you tolerate drawdowns? Can you hold a stock that falls 30, 40, or 50% if the thesis remains intact? Do you have a diversified base first? Do you understand the business? Do you know the bear case? Do you know your position size? Do you have cash reserves? Do you have a time horizon of several years? If the answer is no, these may not fit. Attractive upside does not make a stock suitable for every person. High-growth investing requires emotional discipline. A person can lose money in a good stock if they buy too large, panic sell, or misunderstand the business. Now, if one were ranking these by business type, I would think of them this way. SoFi is the platform financial institution. The payoff is massive if it becomes a banking giant. The risk is credit and recession. ServiceNow is the enterprise software compounder. The payoff is strong if AI fear is overdone and margins recover. The risk is technology disruption and slowing growth. E.L.F is the consumer brand compounder. The payoff is large if affordability, marketing, Rhode, and repeat purchase. Continue. The risk is brand cycle and competition. Celsius is the beverage platform. The payoff is large if Pepsi distribution, Alani, Rockstar, and international growth work. The risk is execution and category competition that gives a portfolio of different growth engines: financial services, software, beauty, beverages, different roads to compounding. Now, let us return to the most important idea in the opening. Where can your life be in 5 to 10 years? People underestimate that window. 5 years of disciplined investing can create a major change. 10 years can create something very different, but only if you combine optimism with discipline. Optimism without discipline becomes gambling. Discipline without optimism becomes hoarding. You need both. You need to believe the future can be better, but you need to structure your investments so one mistake does not destroy you. That is why I like businesses with strong growth and identifiable long-term drivers. SoFi can become a larger financial platform. ServiceNow can remain a critical enterprise software layer. E.L.F can keep expanding affordable beauty and new brands. Celsius can scale a beverage platform domestically and internationally. These are understandable growth stories, but each must be monitored. Now, let us think about what would confirm the thesis over the next year or two. For SoFi, I want to see member growth continue. I want net interest income to remain strong. I want non-interest income to grow. I want credit quality to remain controlled. I want the company to keep expanding products without taking foolish risks. I want profitability to keep improving for ServiceNow. I want subscription growth to remain strong. I want customers to keep spending. I want AI integration to become a revenue opportunity rather than a margin sink. I want acquisitions to integrate well. I want expenses to normalize and net income growth to reaccelerate. For E.L.F, I want core brand momentum to continue. I want Rhode distribution expansion to show strong sell-through. I want Naturium to keep growing. I want margins and earnings to scale. I want the company to keep winning with younger consumers. For Celsius, I want distribution growth. I want international revenue to accelerate. I want Alani and Rockstar integration to work. I want margins to expand. I want free cash flow to grow. I want the brand to keep taking share. If those things happen, the long-term thesis strengthens. If they do not, reassess. That is how investing should work. Now let us talk about price discipline again. SoFi under $15 is very attractive in the source framework. 15 to 20 remains very good. 20 to 25, still good. 25 to 30 becomes more cautious. Above 30 becomes hold. E.L.F under $100 is described as a buy zone. ServiceNow at 90 appears attractive because the base case and bear case still show strong expected returns. Celsius in the low 30s appears attractive because the base case suggests strong compound returns, and even the bear case may remain positive. These price zones are not laws of nature. They are based on assumptions. If the assumptions change, the buy zone should change. If earnings estimates fall, fair value falls. If growth accelerates, fair value may rise. If macro conditions change, multiples can change. A buy target is not permanent. It is a function of the business value estimate. This is why investors should update models, not worship old prices. Now, one more risk must be mentioned. All of these companies can be affected by market multiples. If interest rates remain high or rise, growth stock multiples can stay compressed. Even good companies can trade sideways if the market refuses to pay higher multiples. If recession hits, earnings estimates may fall. If liquidity tightens, speculative growth appetite can weaken. This means timing can be difficult. A stock can be undervalued and still go lower. That is why position sizing and patience matter. Do not use leverage. Do not invest money needed soon. Do not assume the market will recognize value immediately. A long-term thesis must be held through uncomfortable periods. Now, let us close the system. There are 4 growth opportunities. SoFi, a digital financial platform trying to become a future banking giant. ServiceNow, a recurring enterprise software business being punished during an AI and acquisition transition. E.L.F Beauty, an affordable beauty compounder with core brand strength. Naturium, and a potentially explosive Rhode acquisition. Celsius, an early-stage beverage platform with Celsius, Alani, Rockstar, Pepsi distribution, and a global runway. Each stock has attractive upside in the source analysis. Each stock has real risk. The job is not to fall in love with the story. The job is to evaluate the business, buy only when the price makes sense, monitor the thesis, and think in years. If the next 5 to 10 years are handled with discipline, a portfolio can change, but the market will test that discipline. It will give you volatility. It will give you fear. It will give you moments where the stock you like falls for reasons you do not like. It will give you temptation to sell too early or buy too late. The investor who succeeds is not the one who never feels those emotions. It is the one who has a system stronger than those emotions. These four stocks are not magic, they are opportunities. And opportunities become wealth only when combined with patience, risk management, and clear thinking.